Hey, welcome back to the channel. Today we're going to be checking out Innovative Industrial Properties, ticker symbol IIPR. All right, so 5-year chart, here we go. We can see we are on a bit of a sell-off here. So high of about 280 or so. Currently sitting about 67 bucks. COVID lows was around $60. And yeah, let's jump into their investor presentation. All right, so here we have the investor presentation for IIPR as of May 12th, 2023. We're going to skim through it and see what we can find. If you're not familiar with IIPR, they specialize in facilities that are used to grow something. I'll put it that way. They are, target leases are 100% triple net, so pretty capital efficient there. They shouldn't have to really be doing a lot of reinvestment into those properties. Currently, it looks like they have about 2.4 billion committed, 108 properties, 8.1 million square feet, 19 U.S. states. Annualized dividend right now is 720. So the dividend as of now, I think is like around 11%, pretty crazy. Q1 revenue 76.1, 15 years average lease length. So a decent amount of long-term leases. Let's see what we can find. So we got a breakdown of public versus private and operator type. And so this is something that I'm going to pay a lot of attention to is 91% industrial, 3% retail, and 6% industrial / retail mix. For this, this space, I am way more on the industrial side. I'd rather see a lot more industrial space than the retail personally. All right, so now we have a little sales slide saying, look how much we grew, which you guys can probably just ignore that because that's insane. It's not going to happen going forward. Rent collections, 100%, 99%, 100%, 97, 98% so far in 2023. And then we have a tenant breakdown. So tenant breakdown, this is something I'm going to pay attention to a lot too, is I want to see the kind of the diversification they have on their portfolio between tenants. So they are heavier in, let's see, PharmaCann is their number one tenant at about 13.5%. Then after that, all the other tenants are below 10%. So they decent, it's like a decent spread. Top 10 is going to equal about 72%. And no tenant accounts for more than 15%, which is pretty good. And additionally, I think it's no state that they lease within accounts for more than 15% as well. So that is also something good to note. All right, so we got a little bit of slide on licensing, zoning, regulatory, just kind of going over the process for having these legal grow operations in states where it's legalized. Let's see here. Underwriting monitoring, yeah, just don't get involved with degen companies essentially. But in this space, I would expect like you're gonna run into things here and there. So let's see. All right, just kind of going over the property types, the need for certain properties. Then here we have kind of growth scenarios under current legalization of cannabis in the U.S., estimated to be about 58 billion in 2030, currently about 35 billion, so decent growth there. But with the potential legalization, that would potentially bump up to 71 billion in 2030, and that is about 11% CAGR for the overall industry. And then we got, let's see, slideshow on the executive chairman and co-founder. And interestingly, I thought this was interesting. You know how we looked at ARE the other day? Well, this guy, Alan Gold, co-founded Alexandria Real Estate Equities, ARE, in 1994 and served as a president and director until 1998. So it's kind of interesting. Like, I mean, it seems like he's been involved with some pretty solid REITs in the past. BMR, Biomed Realty Trust, I don't really know much about that. It looks like it was sold in 2016, but he does appear to have a pretty good track record, at least from ARE. ARE is a very solid REIT. So, although he was only there for, 5 years, 4 years got started, and then probably pieced out. So, senior management team. Cool. Let's go ahead and jump into the financials. And here we go. So they IPO'd, I believe, in 2016. We can kind of see a breakdown of their dividend and cash flow. So they are paying a large portion of their operating cash flow towards dividends. I think they have the objective to pay, I believe it was like between 75 and 85% of FFO out to shareholders via dividends. So at their current prices, I mean, we're looking at a 10-11% dividend right now. So let's go ahead and see bottom line yields from just historical valuation standpoint. Their operating cash flow, operating cash flow yield right now is about 12.55, so pretty high. Net yield is 8.43. And we see operating cash flow and dividend per share. Operating cash flow per share has grown very, very nicely. So as they have diluted the company, they have diluted a ton, but it has been accretive dilution to a per share metric basis. So that is being good. Let's go jump over to some more REIT metrics and see what we can find. All right, so more the same. Dividend ratio, 78%, 69%, 78%. So their dividend ratio to their operating cash flow or their FFO is probably going to be in that 75 to 85% range. Dividend payouts and dividend growth has been ridiculous previously, probably going to slow down. As they've taken a lot of growth over the last couple of years. That growth will probably moderate into something less substantial, but still possibly pretty solid. So we've got long-term debt and operating cash flow. And what we can see is that their long-term debt is not that much compared to their operating cash flow. And if we go to their cash flow coverage ratio, it's about like 77%. So like they can almost cover 100% of their debt with 1 year of operating cash flow. Their interest expense to cash flow is 7.82, so it's very low. And that's looking really good from a leverage standpoint. We will dive into their 10K or 10Q just to validate these, because that is very healthy from a leverage perspective. The thing that you could say that they did well was they did a lot of capital raise via dilution and kept their debt levels very low, and were able to kind of put themselves in a pretty strong position in this higher interest rate environment. All right, and here we are in the latest 10Q. We can kind of see their overall debt right here. We have, let's see, principal notes or principal amount, $4,436. If we scroll down a little bit more, we can see their notes due in 2026. Let's see, 4125, principal amount 300,000, carrying value, and then I believe we can kind of see their overall payments due by year. So we have a little bit coming due in 2024, and then a larger chunk of those notes coming due, I believe, in 2026. So 2026 could be kind of like a cliff for that those notes coming due, but like we have said, looking at the templates, their leverage ratios are fairly low, so that's something that I'm not going to be too concerned about with their debt levels right here, because their cash flow is enormous compared to their outstanding debt. So with something like IIPR, you have to be very, I guess, conscious of the industry they're in, and the thesis a lot of times is going to depend on what you believe that industry will do over the next 10 years or so. If we do go through a legalization, we could see potentially more demand, but maybe there will be more building, obviously. And that might lead to easier access of capital to the companies, though. So IIPR might be a little bit hurt from that. But overall, we can see that they have done very accretive growth on a per share basis through the debt and the dilution that they have done. And their payout ratio right now looks to be around 78%, which is in line with their objectives. So if we go over to the valuation template, let's go ahead and go over to the REIT template. They are pretty relatively new, 5 years or so. 6, 7, 8, whatever. But they've scaled up a lot in the last 5 years, and I don't believe that they're going to really scale at that rate of growth going into the future. So in the model, what we're going to do is we're going to kind of subdue the dilution, and we're going to subdue the growth as well. So right now we have dilution from about 13.5% down to 11%, and growth from about 13.8% to 12 or 26%. So in the bearish case, not only are we assuming that they're going to dilute decently, but they're going to dilute, and it's not going to be really accretive dilution. Over the last 5 years, we can kind of see they've diluted at a rate of 31.11%, but they've had a bottom line growth of about 76.45%. So it's been very accretive, the dilution that they have done. And we can also see that in kind of, operating cash flow. So we can see, 46% dilution, 186% growth, 83% dilution, 146% growth, 34% dilution, 70% growth, 5%, 24% growth. So we can see that they're diluting less, and they are at the same time still doing accretive growth, but less accretive growth. All right, so for IIPR, I've got a target rate of 12.5% with a 2.5% margin of safety. So just on the price of the equity, it'd be 15% target CAGR. And then if we add the dividend yield on top of that, we're looking at like a 25% target CAGR in this model. So we have 10-year treasury of 4.87 to 1.99, dilution from 13% to 11%. Bottom line growth, bearish scenario is 13.8%. Very bullish scenario is 26.45%. And then we have yields. So we're not doing operational cash flow only on this because they do have really good net income and EBIT along with operating cash flow because they're not really depreciating a ton of assets away. So we have a bottom line fair value yield average of 7.73% in the very bearish case, or 4% in the very bullish case. So 7.73 would be a PE of around like 12-ish, something like that. And the very bullish case, that would be a much higher PE. So let's see, with these kind of assumptions, we can kind of see the fair value estimate right now is right in between, probably like 85 to 128. The very bearish price buy point is going to be about $43. Bearish buy point would be $59.68. Base case would be $82.15. Bullish would be $114. Very bullish would be $162. So it is getting into those ranges where it's closer to those bearish and very bearish scenarios. Now, I don't know. This one's it's an interesting one because some of their tenants are defaulting or have defaulted. I think the market is assuming more defaults going forward. But the interesting with IIPR is that because they are so lowly leveraged, even if you have tenants not paying rent for a substantial amount of time, you're probably not going to be in a huge jeopardy because your leverage profile is really, really low and it's built up pretty well. So most likely, IIPR could go through a huge pullback in operating cash flow due to, tenant issues or leases being canceled, and they would still have a fairly healthy business, in my opinion. So that's it for IIPR. Hope you guys are having a great day, and we'll catch you later.